Let's talk about the myth that everyone should have an emergency fund. I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. And in this video, I'm going to talk to you about why I think holding a bunch of cash is generally a bad idea. So we all just take it as a given that we need to have an emergency fund in case some unexpected event comes up. But I'm going to explain to you why I think this is really crazy and outdated. Now, I am just talking to financially responsible people. If you are someone who does not have any discipline around money, or for whatever reason you just don't have a lot of money, you should skip this video. But if you're someone who is financially responsible, I think holding cash at any given time can be one of the worst decisions that you can make with respect to managing your money. So why is it so bad to hold cash? There's two main reasons why holding a bunch of cash is a bad idea from a financial standpoint. The first one is inflation. I think most of us understand this, but because of inflation, which is always present, the value of your money is going to go down every single year if you just hold it in cash. So instead of investing that money and getting a rate of return that exceeds inflation, if you're holding cash, it is a guaranteed loser. The purchasing power of that money is going to decrease every single year. This is why most economists understand that cash is really more of a liability than an asset. And one of the biggest mistakes I see people make is park a bunch of money in something like a money market account, thinking that they're getting a high rate of return and interest, but that is really often misleading. That interest rate is rarely, if ever, keeping up with inflation, and it is a really bad decision to put your money or do something with your money that you know is a guaranteed loser. The second reason is opportunity cost. If you are going to be an investor and try to get financial freedom, you are going to have to understand opportunity cost. Opportunity cost in the financial world means that you are losing the investment returns you could have been making on that money if you had made a different investment. So with money, you want to be putting your money to use in the most efficient way possible. That is never going to be cash. Cash is earning nothing. You are not putting your money to work when it's just sitting in cash. Even if you're getting an interest on that return that's paid by the bank, it is probably very low, or as I mentioned before, not keeping up with inflation. A good investor should easily be able to get at least 10% returns on average every year. So if you're keeping money in cash, that means your opportunity cost is at least 10% a year. And that is massive when you think about that in the context of how much net worth or wealth you could build over your lifetime. So what should you be doing instead of just sitting money in cash? You should be investing it. There are tons of liquid investments that you can make where you could sell that asset and get access to the cash pretty quickly. I'm going to talk to you a little bit later in this video about some practical examples of events that could occur as to why people think you need an emergency fund. But I've never understood why there would ever be something where I needed access to cash instantaneously and I couldn't just take a few days to sell some shares of stock, sell my crypto, sell some other liquid investment I have, raise that money, take it out, and pay for whatever it is I need to. So this is why I operate one of my smaller brokerage accounts as a checking account. I don't like to sit money in cash, however little amount it is. Instead, I keep it invested in the stock market. And if something came up where I needed access to that money on short notice, I would either sell shares of stock to raise the cash, or I would do an SB lock. I think a lot of this concept around emergency fund is built on people thinking that we're financially irresponsible, that something's going to happen where we need cash and we're going to be in this dire situation because we just have no access to it. But if you're financially responsible, I will never understand why you can't keep that money invested in something like the stock market, crypto, or some other liquid investment. And then if for whatever reason, one of these crazy events comes to fruition, just sell that asset, pay off whatever it is you need to pay off, and go about your life. So to further illustrate how crazy it is, this idea that financially responsible people need an emergency fund, I asked Chat-GPT to give me a few examples of common reasons why people should maintain an emergency fund. And the results are hilarious. So to start with, this is the kind of quintessential reason that everybody always comes up with. You have some sort of accident. For some reason, your health insurance isn't paying the vast majority of that accident, but you've got a medical emergency and you need to pay a bunch of money that you weren't expecting. So here, I've never understood why this is the case. Is the hospital going to come at me with a gun and say I have to pay it right this second? I can't have a few days to sell some shares and raise that money. That just seems kind of crazy. We can see how silly this is. The hospital is really going to take months probably to ever even send us a bill. And also, if you have adequate health insurance, it should be paying the vast majority of that. So why, as you'll see as a recurring theme throughout a lot of these, can I not just sell shares, sell crypto, sell an investment, and pay for whatever that money, is needed for? Job loss is really an interesting one. So I think this one needs to be unpacked in greater detail. It's kind of crazy to me that you have a situation where you could lose your job and then you would structure your entire finances around that possibility. So why are you relying on such an unstable income source in the first place? I think that's a bigger problem to think about. But also, what's going to happen if I lose my job that I can't, again, start selling off investments? And that does actually happen in practice. People get fired for whatever reason. They have to start selling assets because they're having expenses that they weren't expecting to not have income to pay for. But again, why can't I sell investments to pay for whatever I need in that scenario? So home repairs and car repairs kind of go together. Hopefully you have insurance to prevent against any big accidents that could happen with either one of these. I don't know what you guys are doing to your cars to cost so much money, but again, if something unforeseen does come up, don't understand why you can't sell investments and why you have to have the cash immediately. Family emergency. So I hear this one a lot too. What kind of family emergency are we talking about? I mean, travel expenses is kind of crazy. Does your family live on Mars? Why would it cost you more than a couple $100s to get to your family? So this one just kind of doesn't even make any sense. Unexpected travel. Again, where are we going that costs so much? Surely we're not basing financial planning off the fact that there could be some fact pattern where someone's having to pay a few $100 to fly somewhere and can't easily pay that with salary or other sources of income. Here, I think you can start to see where this concept of an emergency fund is really focusing more on financially irresponsible people. The last one is probably my favorite, pet emergencies. This has to be some sort of joke. So you're telling me I'm going to hold a bunch of cash in case my cats have some sort of medical emergency. I do live in New York City, and I will tell you, I pay a heck of a lot more money than I ever thought I would for my cats just to take them to the vet every year. But this is really kind of crazy that I'm going to have an emergency fund on hand because something's going to happen. I don't know, maybe my cat's going to need a lung transplant or something that's just going to cost a bunch of money. But then that gets back to that same concept of why can't I just sell an investment to raise the money? Why do I need the money right now? So we now probably understand that instead of holding money in cash, we could make investments in liquid assets. And so if we ever had some unexpected event occur and we needed access to money that we can't otherwise get, we could just sell some of those assets to raise that cash. But I know at least some of you are thinking, what if I invest that money instead of sitting it in cash and the value of my investment goes down? So this is, I think, one of the most outdated, unfounded statements people make about investing. I think this is really kind of more based on fear mongering, more based on crazy events, and more based on just a misunderstanding of how investments and assets work, largely the stock market. So let's look at trends over time. This is the S&P 500 from 1925 to present. So what you can see here, I'm going to ignore this kind of first little bit here, but what you can see is that it always goes up over time. Yes, there are some dips, recessions. You can see a bunch of recessions here. But what happens? It always recovers and continues going up. Good investments are investments that appreciate over time. Smart investors make long-term investments, and those long-term investments will hopefully appreciate over time, meaning you don't care about short-term temporary dips. This is what happens with the stock market. I think people who think about, oh, my investment could go down, they're probably looking at a concept of I put all my money in right here and then this happens tomorrow or next week. That is not the way investing works. With the stock market, with this concept of instead of parking money in cash, you're going to put it in something like an S&P 500 index fund and use that as your checking account. That is not something where you're going to just put all your cash in here one day and just get really unlucky and it goes down the next day. Hopefully that's not what you're doing. You are adding money over time. You are making investments over time as you have more and more savings. Yes, you could, look at your stock market here, your portfolio. You could see, wow, it's really high. and then look the next week and it could be down there and be down a lot. But that is not the way to judge the value of your investments. You don't look at the highest point it ever was and then look at the lowest. You look at it on average every year since you've been investing. So anyone who thinks about the stock market as being very risky, there's someone looking at the peaks and troughs, right? They're thinking, yesterday my investments were up, $100. Tomorrow they're down 200. That, again, I cannot stress that enough. That is just not the way smart investors look at their investment portfolios. You need to be thinking about values 10, 20, 30 years from now. So yes, something could happen where here my cat needs a lung transplant. Darn, it's not lucky that I have to sell shares on that day because yes, they're down in value, but I'm not selling my entire stock portfolio. I mean, hopefully we've got more money saved than that. Hopefully we don't have some crazy event that's not going to happen to the vast majority of us that requires us to sell a bunch of that portfolio. But yes, that could happen, but that's not the end of the world. You still have a bunch of other money and hopefully you've still got that money invested and you're sticking with it, because what matters is not that I had to sell some shares here to pay for my cat's lung transplant. What matters is when I'm 50, 60, 70 years old, passing this money down to my children, this is the value of my portfolio. And yes, I did have to sell a couple of shares to raise money, but what would the value of that be if instead of investing it, I had left it in cash? That is what you have to understand. You can easily see, looking at this chart, how opportunity cost works. And you can also easily see, just by common sense, that if instead of investing your money and it going up over time, you had left it in cash and it's going down in value over time, that is a bad result. So don't let this idea that yes, investments could go down in value prevent you from, making smart decisions with your money. And don't certainly let this fear mongering allow you to just park a bunch of money in cash where it's losing value every year. So I do just want to end with the one event where I think it might be nice to have access to cash immediately, and that is if there was ever a zombie apocalypse. So I talk a lot about the zombie apocalypse and how I think that a lot of the things we're taught around investing, especially risk and fear around investing, is built on this notion that some crazy event like a zombie apocalypse is going to happen. Even if you are someone who believes that that could happen, I don't think cash is going to help you. The zombies probably aren't going to trade in cash, and the few survivors along with you probably aren't going to want your money either. So even in these crazy fact patterns like a zombie apocalypse, I don't think having your money sitting in cash doing nothing is really going to make you that much better off. So hopefully you found this video helpful. My goal is to debunk a lot of the myths that I think hold back people from ever achieving financial freedom. If you are someone who wants financial freedom in your life and wants it early in your life, you're going to have to put your money to the most productive use possible. And that is never going to be sitting in cash.